Hi, and thank you for giving me your attention for a few minutes as I tell you about our upcoming course called Finance for Scrum Delivery. This is a full-day course that will equip you with the financial and accounting skills specifically designed for the Scrum professional who wants to ensure their project financial success. Today, I will give you a 10-minute introduction into the world of finance for Scrum. We will first cover some high-level general accounting concepts, then go through a little example project, and lastly look at what all this means for Scrum. But before we begin, who am I and why should you listen to this video? My name is DINA GOFMAN. Firstly, over the past decade, I have been involved with hundreds of projects, initiatives, and innovative startups as a project accountant, finance business partner, or advisor. I'm the author of the project accounting framework titled Forgetting the Money, a 10-step framework to harness true project value that can be found on Amazon. I'm the founder of a fintech called Tech that looks at using existing financial and project data to drive helpful project finance analytics. I'm a trainer, and over the past few years I have been working inside organizations that have needed a hand in working through the convoluted world of project delivery and finance. Secondly, I'm incredibly passionate about financial literacy, and this is what drives me to work with project managers, product owners, Scrum professionals, and PMOs to help projects succeed. And financial success doesn't just mean delivering within allocated funding, but the stopping of unwanted surprises from your finance colleagues every time you turn around. In my experience, many of these unwanted surprises come from the misunderstanding of each other, and I'm here to help you understand the finance language as applicable to the Scrum world. Lastly, I'm a certified Scrum product owner myself and have worked in the capacity of both Scrum Master and product owner, which means I have been on the other side asking for money and managing my own budget while working within the Scrum delivery approach. This is why I want to help you achieve the clarity around your financials to ensure your project is successful. In the full-day Finance for Scrum Delivery course, we will cover 5 key topics. First, we will deep dive into some high-level project financial concepts. Not too deep, but deep enough for you to be comfortable to challenge those giving out money. In the second topic, we will look at contract negotiation implications and what the different types of contracts mean for your project, along with what works in industry. Third topic, we'll cover financial planning for your project, in working through some fun examples of how to think through Scrum estimation when planning for your project budget. During the fourth topic, we will look at how to integrate finance into your backlog and retrospectives, looking at some techniques that will help answer how to marry up finance and Scrum. And lastly, we will look at some industry examples and work through some further case studies. At the end of the course, you will be ready to tackle your project financial challenges. Question your actual financial results with confidence, and challenge your finance colleagues when budgets are set. If this sounds like something that can benefit you, please register for the course. In the meantime, let's have a look at a quick introduction to finance for Scrum. Let's start at the basics. Many of you would have probably heard of financial statements. These make up the financial reports that companies produce for the shareholders, regulators, and pretty much for anyone who requests them. You may or may not have known that these reports are pretty standardized. What this means is that the majority of the world got together and defined what is included in these financial statements. These financial statements are broadly made up of the balance sheet, the profit and loss, and the cash flow statement. Today, For our purposes, we will only focus on the balance sheet and the profit and loss statement. Consider these statements to be mathematical laws, and hence, like any mathematical or physics laws, this is the basis for you to learn upon. Everything at the end of the day comes down to these statements. The balance sheet is made up of assets, liabilities, and owner's equity. These are described in a formula. Assets minus liabilities equals owner's equity. In other words, what you own minus what you owe is equal to the residual of what is truly yours. Let's think of this as an example of owning your own home. You have a home which is worth $1 million, but you also have a mortgage against that home for $900,000. The residual $100,000 is what you are left with, also known as owner's equity. The profit and loss statement is made up of revenue and expenses, together making profit or loss. Or in the formula, revenue minus expenses equals profit or loss. So in thinking about renting your home, you will get a revenue of $1,000 a week or $4,000 a month. But you will also have maintenance expenses, such as utility bills, of $2,000 a month. This will leave you with a residual $2,000 a month or $24,000 a year in profit. There is one more statement that helps link the other two mathematical statements together. Profit or loss plus shareholders' equity is equal to owner's equity. Looking back at our house example, if we know that owner's equity is $100,000 and our yearly profit is $24,000, then the residual is our shareholders' equity, which is $76,000. If we join all of these into one mathematical statement, we will end up with assets minus liabilities equals revenue minus expenses plus shareholders' equity, or 1 million minus 900,000 equals 48,000 minus 24,000 plus 76,000, or 100,000 equaling 100,000, which is what accountants call a balanced book. The last part is to highlight here is the orange are called debits and the blues are called credits. Now that we have covered the basics of accounting, the big question is, how do projects fit into all of this? Consider the following definitions of assets and expenses. Assets are broadly something that you own, which means you generally buy these or create them. Assets need to bring probable future economic benefits, and their value needs to be reliably measured. So in the case of building a software asset, you need to prove that you have spent the money and that the software you're building will bring those future benefits to the organization. Expenses are broadly something you consume or lose in order to upkeep the asset or liability. To be recognized as an expense, there needs to be probable consumption or loss of economic benefit related to a decrease in the value of assets or an increase in the value of liabilities. And again, their value needs to be reliably measured. So to differentiate between the two types of costs, companies came up with additional concepts: CapEx and OpEx. CapEx is simply defined as capitalized expenditure, or expenditure that you have proved brings value and hence becomes an asset. This process is known as capitalization. OpEx is simply deciphered as operational expenditure, or expenditure that you pay for because it's not bringing future economic value or benefit. Generally, any expense that cannot be classified as CapEx is an OpEx. Let's put this to the test. Let's look at delivering a project together. The project is building a car. You want to build a car, but you don't have the money to do so yourself. So you go to the bank and borrow $300. With this $300, you buy $250 worth of car parts, of which $50 worth of car parts are faulty. So $200 worth of car parts are considered part of the asset you own and are building, and hence are considered a capex. And the $50 of faulty car parts are considered an expense, or opex. Now you also end up needing to pay the mechanic to build your car, and that is another $100. At this point, you have overspent on your bank loan and need to come up with the cash to quickly pay for the residual owing. So you decide to Uber the car and end up earning $500 worth of revenue. You have running costs associated with Ubering your car, including petrol costs of $100, bank interest on the loan of $15, and your car also depreciates, as it has a finite useful life. So that's another $50. The total of your expenses is $215, leaving you with $285 worth of profit. Don't forget that you still owe tax on that profit of 30%, which ends up being $85, hence leaving you with a nice round profit of $200. This $200 profit equated to the cash that you ended up with at the end of the day. And to balance our books, we also recognize that net profit in our owner's equity. So the question to you, how much did your project cost? I'll give you a minute to think it through. Your project cost you $350 and included the value of the asset and the expensed car parts. Now many of you are going to look at the screen and think, what? Wait, huh? Let's break this down a little. Just because something wasn't capitalized doesn't mean you didn't end up paying for it. You paid for those faulty car parts, regardless of them ending up inside the built car. So hence, they are part of your project cost. These types of costs are known as project OPEX or POPEX in many organizations. The revenue that came from Ubering your car is known as benefits, while the running expenses to upkeep that same car are known as ongoing OPEX. These ongoing expenses include petrol, bank interest, and depreciation. This simple, yet not so simple example shows you how complex the world of projects actually is. Now enter Scrum into the world of finance. Scrum is but one Agile delivery approach. Agile delivery is an incremental approach to the delivery of a project. The team starts off with a simplistic design and then begin to work on small modules. Each module will include elements of design, development, and testing in order to deliver a standalone feature. A culmination of features may deliver a minimal viable product or a minimal marketable product. Even though most conversations are around the delivery of a minimal viable product, in the case of finance, they care more about a minimal marketable product, as that is the smallest feature that has actual value to the organization and its stakeholders. So when we break the Scrum phases down, we look at whether each phase brings expected future economic benefit. Idea generation and inception are phases of research, which the International Financial Accounting Standards recognize as immediately expensed, regardless of their outcome. Once inception is complete and the project gains funding, the first feature is built and is considered a minimal marketable product that is released. It is therefore deemed to be capitalizable and becomes an asset. The second feature is developed. However, during testing, fails. This entire feature is expensed. However, If it is rebuilt to a working condition and is subsequently released, a portion may become capitalizable. That portion highly depends on the amount of reuse of the original code versus rework required. As you have noted, this is not a simple process. Hence, many of your finance colleagues, without understanding the Scrum world, simply expense the whole lot. This is highly unfortunate, as this is not what your business sponsors, shareholders, or customers have signed up for. That was but one small introduction to the full-day course, Finance for Scrum Delivery. In the full-day course, we will cover more high-level project financial concepts, contract negotiation, financial planning for your project, incorporation of finance into backlog planning and retrospectives, and walk through many more industry examples and learnings. So join me by registering for the course to receive further information, or alternatively, send an email to the email on the screen.